For the last 40 years, the United States financial system has relied on a silent partner. A partner that never complained, never asked for a raise, and never threatened to leave. That partner was Japan. But 3 days ago, the phone rang in the U.S. Treasury Department, and the message on the other end wasn't a negotiation. It was a notice of eviction. While American media is distracted by stock market rallies and political noise, the Bank of Japan has quietly pulled a trigger that economists have feared for decades. They haven't just tweaked the policy. They have effectively declared that the era of funding American debt is over. And this decision is already sending a shockwave through the bedrock of the U.S. dollar that is far more dangerous than any recession we have seen before. To understand why this is happening right now, you have to understand the role Japan plays in your wallet. Japan is the largest foreign holder of U.S. government debt. For a generation, they have taken their trade surplus, the money they make selling Toyotas and PlayStations to Americans, and recycled it back into buying used Treasury bonds. This relationship allowed the U.S. government to borrow trillions of dollars cheaply. It kept your mortgage rates low. It kept the government funded. It kept the dollar strong. It was a perfect symbiotic relationship. The U.S. got cheap loans, and Japan got a safe place to park its cash. But that relationship was built on one specific condition. The Japanese yen had to remain weak, and Japanese interest rates had to remain at zero. That condition just expired. The Japanese economy is currently facing its worst currency crisis since the 1980s. The yen has collapsed in value, causing massive inflation for the Japanese people. The cost of importing food and energy into Tokyo has skyrocketed. The Bank of Japan looked at the board and realized they had two choices: let their own country burn to save the U.S. bond market, or burn the U.S. bond market to save their own country. They chose survival. Japan has begun the process of unwinding. They are raising interest rates. They are intervening in currency markets. And most critically, they are selling U.S. dollars to buy back their own yen. This is the equivalent of your biggest credit card. Lenders suddenly demanding you pay off the balance immediately. The U.S. market is flooding with sell orders for treasuries coming from the East. And when you have a seller of this magnitude stepping away from the table, there is only one direction for the U.S. dollar and U.S. debt to go. The floor is falling out. But this isn't just about a bank changing its rates. This is about the collapse of the greatest free money trade in history. A trade that Wall Street has used to leverage the entire American economy. And that trade is blowing up in their faces as we speak. To really grasp the magnitude of the disaster unfolding, we need to talk about the yen carry trade. It sounds technical, but it is actually the drug that Wall Street has been addicted to for 20 years. It works like this. Imagine if you could borrow $1 billion from a bank in Tokyo at 0% interest, basically free money. Then, you take that $1 billion, convert it into U.S. dollars, and buy used bonds paying 5%. You pocket the difference. It is risk-free profit. It is free money. Hedge funds, banks, and institutional investors have pumped trillions of dollars into this trade. They borrowed in yen and bought in dollars. This artificial demand is what has propped up the value of the U.S. dollar for years. It created an illusion of strength. But what happens when Japan raises interest rates? Suddenly, that free money isn't free anymore. The cost of borrowing yen goes up. At the same time, the yen starts to strengthen against the dollar. Now, the hedge funds are getting hit from both sides. They have to pay more interest on the loan, and the currency they borrowed is getting more expensive to pay back. This triggers a margin call from hell. Wall Street is currently forcing a mass liquidation. They have to sell their U.S. assets, stocks, bonds, real estate to get the cash to pay back their Japanese loans. This is the mechanism that destroys the dollar. We are seeing a massive flow of capital reversing direction. For decades, the river of money flowed from Japan to the U.S. Now, the river is flowing backwards. This is a liquidity shock. When trillions of dollars are suddenly repatriated back to Tokyo, it leaves a vacuum in the U.S. financial system. Who is going to buy the U.S. debt now? Who is going to prop up the stock market? The Fed? They are already fighting inflation. They can't print more money without destroying the currency further. This unwinding exposes the fragile reality of the American economy. We haven't been growing because of productivity or innovation. We have been growing on borrowed time and borrowed yen. The Japanese have effectively called in the loan. The scary part is the speed at which this is happening. In previous cycles, these shifts took years. Today, with algorithmic trading and high-frequency systems, the unraveling is happening in days. The U.S. dollar is losing its biggest structural support pillar, and the market is realizing that without the Japanese bid, the emperor has no clothes. The addiction to cheap Japanese capital is over, and the withdrawal symptoms are going to be agonizing for the American consumer. The immediate victim of Japan's pivot isn't the stock market. It's the U.S. Treasury market. And this is where the situation turns from a financial problem into a national security crisis. The U.S. Treasury bond is supposed to be the risk-free asset of the world. It is the foundation upon which all global finance is built. But prices are determined by supply and demand. The U.S. government is currently issuing debt at a record pace, borrowing $1 trillion every 100 days just to keep the lights on. Supply is at an all-time high. But thanks to Japan pulling the trigger, demand is falling off a cliff. When Japan stops buying, or worse, starts selling their $1.1 trillion stockpile of treasuries, yields must spike. Yield is the interest rate the U.S. government must pay to attract buyers. When there are no buyers, you have to offer a higher return. We are watching the 10-year Treasury yield, the most important number in global finance, climb toward dangerous levels. Why does this matter to you? Because the 10-year Treasury dictates the 30-year fixed mortgage rate. It dictates the interest rate on your car loan. It dictates the rate on your credit card. As Japan exits the building, they are taking low interest rates with them. We are staring at a future where mortgage rates don't go back down to 3% or 4%, but stay structurally stuck at 7%, 8%, or higher. The U.S. housing market, which is frozen, could crack completely under this pressure. But the bigger problem is the U.S. government itself. The United States is $35 trillion in debt. If interest rates rise because Japan leaves the market, the cost to service that debt explodes. We are already spending more on interest payments than we do on the entire defense budget. If yields spike further because of Japan's capitulation, the U.S. enters a death spiral. We have to borrow more money just to pay the interest on the money we already borrowed. But to borrow that new money, we have to issue more bonds, which pushes rates even higher. It is a mathematical trap. And for the last decade, the only thing keeping us out of that trap was the Bank of Japan suppressing global rates. That suppression is gone. The widowmaker trade betting against Japanese government bonds has finally arrived in America. The bond vigilantes are back, and they are realizing that without the Japanese backstop, the U.S. Treasury looks a lot less like a risk-free asset and a lot more like a subprime mortgage. This places the Federal Reserve and Jerome Powell in an impossible nightmare scenario. The Fed has been fighting a war against inflation for 2 years. They raise rates to cool down the economy. But Japan's move undermines everything the Fed is trying to do. If U.S. bond yields soar because of Japan selling, it tightens financial conditions so aggressively that it could cause a banking crisis in the U.S. We saw what happened with Silicon Valley Bank when rates went up, banks failed. Now imagine that on a systemic scale because the biggest buyer of bonds, Japan, went on strike. The Fed will be faced with a binary choice, and both options lead to destruction. Option A, they let yields rise. This defends the dollar but crushes the U.S. economy, destroys the housing market, and bankrupts the U.S. government via interest payments. Option B, the Fed steps in to replace Japan. They turn on the money printer and buy the bonds that Japan is selling. This is called yield curve control. It saves the government and the banks, but it destroys the dollar. If the Fed prints trillions to soak up Japan's selling, inflation will return with a vengeance. We are talking about double-digit inflation that doesn't go away. The market is starting to sniff out that option B is inevitable. They know the U.S. government cannot afford real interest rates. They know the system is too leveraged to handle a spike in yields. So, the The smart money is betting that the Fed will eventually sacrifice the dollar to save the bond market. Japan's move has forced the Fed's hand. They can no longer pretend to be in control. They are reacting to Tokyo. The sovereignty of U.S. monetary policy has been lost. This creates a crisis of confidence. The U.S. dollar derives its value from trust that the Fed is in control, trust that the debts will be paid. Japan's exit signals that the smart money is losing that trust. When your oldest, most loyal ally starts dumping your currency to save their own, it is a signal to the rest of the world. Get out while you can. China is watching. Saudi Arabia is watching. The BRICS nations are watching. They see the vulnerability. Japan didn't just hurt the dollar financially. They wounded it psychologically. They proved that the U.S. is dependent on foreign capital to survive, and that capital is no longer loyal. We are witnessing the end of an era. The era of exorbitant privilege, where the U.S. could print endless amounts of money and export the inflation to countries like Japan, is over. Japan has effectively closed the export window. The inflation is now staying home in America. This shift marks a fundamental restructuring of the global financial order. For 80 years, the dollar was king because everyone bought it. But we are moving into a multipolar financial world where nations prioritize their own domestic stability over the health of the U.S. dollar. Japan's decision is the first domino. As the yen strengthens and capital flows out of the U.S., we will see a repatriation of wealth back to the East. This means the U.S. stock market, which has been inflated by global liquidity, faces a decade of stagnation or decline. It means the purchasing power of the average American, which was artificially boosted by a strong dollar allowing for cheap imports, will erode. The everything bubble was built on the foundation of the yen-carry trade. Japan just popped the bubble. This is the end of the United States, but it is the end of the easy mode economy. The days of 30-year fixed mortgage at rock-bottom rates are gone. The days of the government passing trillion-dollar spending bills without consequence are gone. Reality has arrived. The trigger pulled in Tokyo has set off a chain reaction that cannot be stopped. The dollar is being repriced, not as the only game in town, but as a currency backed by an insolvent government and a trapped central bank. The irony is tragic. We spent years worrying about China dumping our debt or Russia abandoning the dollar. But the blow that finally broke the system didn't come from an enemy. It came from our closest friend. Japan did what they had to do to save themselves. Now, the question is, what would the United States do to save itself? The answer will define your financial future. The dollar isn't dying a slow death anymore. It's being deconstructed in real time. The trigger has been pulled. The bullet is in the air. And the American economy is standing directly in its path. Prepare accordingly.